JP, here we are in Atlanta.
Yes, we are.
The 404.
Yes, or the 678 or the 440.
No.
Depending on when you moved here.
No, the 404.
It is the 404.
And that is our new phone number.
Yes,
so
it is.
I wanted to make sure, but before we put this video out, let everybody know we have new phone numbers. If it comes from 404, it is us.
Yes.
But check your email, put them in your phones, please. Mr. 305 Worldwide has come back from Miami, left all that behind, and we are officially going to recognize Atlanta, which influences everything.
Yes, absolutely, especially in the South.
Everywhere.
Yeah.
Everywhere. So with that out of the way, you don't know what we're talking about today.
I don't.
We are going to talk about a strong or weak dollar because that impacts our clients' portfolios. It impacts the economy. Mm-hmm. And I would like you to describe, let's say I'm going to Paris this summer, mm-hmm. which I never go to Paris in the summer. But let's say I did.
It's hot. You gotta go to Nice.
Let's say I did. It would be an empty city.
Sure. Would
my wallet be more empty? Not? Explain a strong and weak dollar, please.
Yeah, sure. So, normally if you think about like weightlifting and strength, you would say, wow, that person's really strong. I mean, they can like move a lot of weight. But when we talk about currencies, strong is a relative term because it's always strong compared to what?
Right.
So when you go to Europe, you will be...
It's like you practiced this, but you didn't know the topic. Right? That's a great analogy. Keep going.
I appreciate it. So the euro is the predominant currency in the European Union. France is a European Union country. Right?
Yep.
If you're in England, it's the Great British Pound. If you're in China, it's the yuan, Japan, the yen, et cetera, et cetera. United States, it's the dollar. So for our purposes, and most of our clients are in the UK or in the US predominantly, all that really matters is that the US dollar is stable because we use it to transact with our purchases. You buy a car from a local dealership in dollars, buy a McDonald's hamburger in dollars.
JP,
but
let's get to the topic.
No, totally.
I'm going to Paris.
This is all important. But when you go to Paris,
yes,
that hamburger is going to cost a different amount of money, right? And so what you need to know is if I have US dollars and I take them and convert them over to euros, is it going to buy me more or less stuff? And so when we have a strong dollar, it will buy you more stuff in a foreign country, right?
Yeah.
You have more purchasing power. That's what it means to be strong versus another currency. If the dollar is weak, and you go over there, you're going to need more US dollars to buy the same equivalent amount of the foreign currency.
So weak dollars, more people will buy from the US.
Ideally, because then they have more of an incentive to use their strong currency to buy our stuff.
I was going to make fun of you in the hamburger comment, but actually the best cheeseburger I ever had was in Paris.
Oh,
yeah,
really?
Yeah, best meat, best bread, best cheese. It makes sense. Mm-hmm. Like, why wouldn't it? They just put it all together.
Right.
Right now, the dollar is weak or strong compared to most currencies or the currencies that we're tracking.
So it was strong going into this year, and it is trending weaker throughout this year because of different U.S. trade policies.
Well, let's just call them taxes.
Yeah, taxes or tariffs.
Tariffs are taxes.
Right. Of a different kind. They're not ones that you pay to the IRS, but they're ones that you pay through importing and exporting goods.
Yes, and then to the American consumer, do we pay him?
Indirectly.
Sounds like a tax to me.
Yep. Exactly. You're totally right. So the companies will pay it. They'll pass those costs on to consumers because they want to maintain their margins.
Yeah.
Things cost more money as a result of it.
All right. So how does the weak dollar, and maybe tariffs too, but how does the strength of this dollar impact our portfolios?
Oh, sure. So if we have a strong US dollar, any of our US domestic companies that go out and do operations outside the United States, operations can be opening up a business in a foreign country and operating there with their services, or importing goods to produce materials here. They're more effective at that, right? Because if you have a strong currency, you can buy more of other things in other currency. So if you're buying a lot of things from Mexico, we historically have had a really strong dollar to peso conversion rate. We can just buy more and more things from them at better rates.
So we got like a weak dollar right now. Shouldn't we be buying a ton of stuff? Have we been buying a ton of stuff?
Historically, Americans have been buying a ton of stuff. We're the number one importer of goods in the world, right? We're the largest buyer of things globally.
We're the world's consumer.
We are the world's consumer. And our economy is 70% consumption. That's so if our dollar goes down, it changes the whole calculus on that. And it can have a lot of cascading effects.
Is that true right now?
It's starting to be a little bit true. So there's the tariff pauses are mudding this a little bit, but we saw in the Q1 economic data that net exports were the highest they've ever been. And imports basically were all front loaded. So once the tariff announcement came down saying, here's the policy you want to do, here's the timing, more goods came into this country in 1 month than have ever come to this country ever.
And wasn't that pharmaceuticals and people front running it and
companies? Yeah, it was a ton of all kinds of industries.
So it's not like, so that's the problem with this data that we're getting as we're managing these portfolios and trying to figure out what we're going to buy or what companies we want to be in, is this data isn't clear. It's distorted because you're like, oh, great, we've got more, we're importing more. No, we're just doing it because people are afraid of tariffs coming down. And so then the next couple quarters are going to be muted because it's not like all of a sudden Americans are using more diabetes medicine.
No. And companies have agency and they have supply chains and they're able to overorder, right? It doesn't really make sense when everything's nice and stable to go buy more things if you're not going to sell them. But if you know the cost of all your goods or your inputs are going to go up, you may just go buy those inputs now, put them on a shelf, and then build those products later. It gives you a buffer to kind of, push out that cost to a little bit later.
Sure. And they are doing that. Mm-hmm. And it's like, you got to watch, like, there's like this man behind the curtain. Like, it's like, if you just look at the numbers, you'll be like, this is great. Our economy is doing wonderful. But there are some deeper challenges at play. Mm-hmm. And the numbers aren't really telling us what we need to know.
Right.
So now the question is, and the question I want to go with that we've been keeping with is, okay, so the dollar's weaker. Mm-hmm. How will that impact companies? In fact, it's hard to say because a lot of the weaker dollars, because of these tariffs or because of these trade wars or taxes, as we're talking about. How does that impact how we at Conscious Wealth and how somebody at home, if they want to make their own decisions, can look into and study on what they want to do in terms of adjusting a portfolio?
Yeah. So one of the first things you can do is know what you own. Something we tell all of our clients about is know what you own, know why you own it.
Yeah.
Part of knowing what you own is knowing how a company makes money, right? And knowing where it gets its inputs from. A company that's entirely based in the United States or just gets a majority of its imports from, and materials from the US is actually going to be really insulated from this, right? So those companies theoretically should do better in a market like this.
Yeah, it's hard to find that company.
It is hard to find that company.
Yeah, because not only, like, it's very few companies are manufacturing and sourcing from here.
Mm-hmm.
Yeah.
That's absolutely true. We really don't have the industrial base. So then we have to go a step further and say, okay, companies writ large are going to be impacted by this because of global supply chains. So then we have to find out and say, okay, what companies have really strong margins, right? Because you would think this could be inflationary, meaning that if the cost of inputs goes up, the cost of the output's going to go up, and it costs us more money as consumers.
Yeah.
When consumers see prices go up, sometimes they just don't spend as much money. That can be bad. So are there companies that have really strong margins that can absorb these costs?
Yeah.
Right? Sometimes they either choose not to pass them along, or they've just kind of taken the steps over time to diversify and hopefully keep their margins really intact.
So margins is one thing. The other is size. So in this idea of the spectrum of really big companies and really small companies, makes a lot of sense to go towards the big companies for looking for stability because they can weather whatever is happening.
Yeah, I mean, Apple was told they shouldn't manufacture in China, so they're going to build a plant in India.
Yeah.
They can do that because they have $200 billion of cash, right? So without even taking on debt, they could just go build a new plant and totally move one of the largest consumer technology operations in the world to another country. A lot of companies can't do that.
Stay tuned for the results on that in 2 years.
Totally won't end up back to China.
So big company, small company, maybe in an environment like this, you're leaning towards big. I say maybe. We are.
Yeah,
right?
definitely.
And maybe somebody at home will decide to do that. Mm-hmm. International or US-based in this environment?
Yeah, I mean, it depends because if you were to look back at the data over the last 10 years, the international market did horribly relative to the United States, right? It's always an opportunity cost. You either put it here or you put it somewhere else. This year to date, it's been the best performing market. Now,
what has been?
The European market.
The European market.
Now, part of that is currency strength, right? So these companies could have done just as good as they were always going to do, but because the US dollar is getting weaker, you now have an upswing towards a foreign market, right? Yeah. So currency sometimes can make or break the return on the investment in a foreign country. So that's part of that, and you have to figure out what that is. But the other part of this is, look, some people are going to say the US has some instability. I want to move my money out of the US into foreign markets. And I would say you can do that, but just know that if you think you don't know a lot about US companies, just wait till you read a 10K in German, because it's a lot more difficult to understand how foreign companies operate, how they make money, where they're entrenched, because you just don't have the ability to go to Publix and see what's on the shelf in Germany. Right? It's a totally different way to play the game.
It's a different way. Also, when I say U.S. markets international, we're assuming that they're these like indexes or these like really large groups.
Sure.
And at our company, and what we encourage people to do is to know what you own, know why you own it, right? We didn't come up with that saying, but we definitely adhere to it. And so investing in the whole European market is a really murky thing. And if we were going to, and when we invest in that space, we're going to invest in a company, maybe two. There may be a handful of companies in Europe that we want to, but as a thriving marketplace, Europe may be a good trade, but it may not be a great investment.
Sure. And a lot of people, when they get nervous, make trades that they think are investments, right? So they say, oh, well, the U.S. isn't doing well, let me roll into Europe. And then they're in Europe and they forget to get back into the United States. And then maybe everything settles itself out. Maybe, the United States has more long-term growth and they've been holding the bag in a foreign country or a foreign market the whole time. So, it's part of it is also resisting the urge to jump ship and go to the next hot idea, because when things settle down, you don't have that fear response pushing you back to the thing you want to do, which is find high quality long-term investments. And you may actually stick yourself in the wrong investment.
Well, the problem is we don't know when things are going to settle down, and they're not going to settle down on this logical thing like, oh, well, we have these 5 economic factors and we have these trends. Like, and then there's this rational thing that moves. Like, this market is not being moved by a rational thing. It's being moved by emotions. It's being moved by tweets. It's being moved by policies that are unilateral. And so in absence of that, we lean towards big, we lean towards US, and we lean towards long-term investing. And that's what we spoke of last time.
Definitely.
Like, long-term investing is the play right now, buy and hold, because we're seeing the market move 800 points a day. The only thing bigger than long-term investing for us right now, or more influential, is asset allocation. The idea that where you have your money, whether it's stocks, bonds, cash, or some type of alternative non-stock bond or cash investment, is going to be 90% of your return.
Yeah, absolutely.
90% of your return is going to be in what asset classes you're in. And then stock selection will get you your extra 10 maybe.
Absolutely. And I don't know where we'll include this in the video, but the most irrational thing I've seen was, I told you about the industrial companies. Every CEO of an industrial company in the United States mentioned tariffs. Every single one has an international supply chain. It was the last sector to go negative in the downturn in April. It's the most exposed sector in the United States to that one specific risk factor. And until the clipboard or the infographic was shown, it was the last sector to be net negative.
Is that just the assumption that all this industry is going to move back to the U.S.?
I have no idea what it was, but it was the most, in hindsight, it was one of the most obvious trades, because, tech, energy, all these things were down. And they really didn't have the same kind of exposure or risk factors.
Obvious trades are losing trades.
They are over long periods of time, right? Like, an obvious trade is one of those things where it's like, it's only obvious because now I have the context of 2 months later and I gotta look back at it.
Oh, that's an easy trade. I should have known. Everybody knows.
I'm so silly.
All right. So weak dollars here for now. May stay that way. There's some advantages, disadvantages. Not all of it's real. And when I say real, it's not. It's being propped up by policy, not any type of economic.
Right. The fundamentals really aren't in yet.
They're not really in yet. We're making adjustments. We're leaning U.S. We're leaning big. Asset allocation is equally important. And the family's back together again in the 404.
It is.
We're working like we have clients internationally, but we're based out of Atlanta now, and it's good to be back.
Yeah, it's good to have you back.
Thanks, man. Aw. All right. I hope you're still on vacation since the last time we saw. Any questions, please give us a call. We love y'all.